Today I'm going to be presenting Quant Companion, a tool that can help you further analyze your backtesting results from TradingView. Let's get started. I have a strategy over here in TradingView already. I'm running the deep backtester to get a few more data points. To be able to utilize the data, I need to go to the list of trades. I'm going to export this data. I'm going to save as, and I'm just going to call it new trades. I'll just call it trades, so that it doesn't conflict with any other names that I have here. And then I'm going to go to the Quant Companion. I'm going to upload the trades that I have. And now I can use Quant Companion to start analyzing this data. Starting at the top here, I have there's the properties pane, which will allow you to change the starting equity if you'd like. Probably more importantly is the ability to remove some trade data, so you can remove your best trades or your worst trades. I don't think removing your worst trades would help you out that much, but removing your best trades can definitely help you identify if your strategy is more robust. And what I mean by that is, if we take a look at our win rate over here, it's 68.72%, a 68.72% win rate. And it's still profitable if we're looking at our cumulative net profit here. And what I can start to do here is I can start to remove trades. And these are removing specifically the best trades. And so knowing that I have 642 trades over this trading period, if I remove a large number of the best trades and the strategy is still profitable, I would have higher confidence that this strategy is going to be profitable if I were to make a mistake and miss some trades or something like that, right? So I've moved this up. I've removed the best 20 trades, and this strategy is still profitable. Let's go on to some of the other statistics here. So the other statistics up at the top here are, some of them are the same that you'll get from TradingView. The key ones that are not in TradingView is the median profit, the MAR ratio. So this is annualized profit over your max drawdown. And another one that I've recently learned myself is net profit over average drawdown. Using your average drawdown can help you identify situations where, can help you analyze strategies in a way that would identify smoother equity curves as opposed to just focusing on the max drawdown. Obviously, it's important to know the max drawdown and ensure that your strategy is going to be robust to those particular situations, but that might be one case out of the entire life cycle of the strategy. And oftentimes it is more important to understand, or it can help you identify, as I mentioned, a smoother equity curve if you identify one that is taking into account the average drawdown. The next metric that I want to mention here is the Sharpe Ratio. So the Sharpe Ratio is something that you'll get from TradingView. However, this Sharpe Ratio is annualized over the date period that we have. So I'm making a projection over the date periods provided by TradingView. So it's an attempt to annualize your Sharpe Ratio. Moving on to the next point here is the Monte Carlo simulator. This particular Monte Carlo simulator uses sampling with replacement. So it's basically going to use the profit data that you provide, and it's going to continually select those values, and it could select the same value multiple times. And one of the reasons we do that is if you were to filter out that information as you select a particular trade, you're ultimately just going to end up with the same exact results that you end up with in TradingView. And so this, again, allows you to have an idea of what a projected future might look like. It's not going to help you out in situations where you have overfit data. If your data is overfit, you give it bad data, then you're just going to ultimately get bad results. So assuming you have already forward tested your data and you're comfortable with the information that you have, this can help give you a projection of what your future results might look like. You can increase the number of runs that you have here. By default, we're doing 100. You can increase the number of future points. So essentially, this will project farther into the future. You can also remove your best runs or the worst runs out of the simulations. And you can additionally just continually rerun this here. Making a change to any one of your inputs here is going to will cause this to rerun. But if you just want to rerun it yourself here, you can do that. interacting with these charts have some interaction, so you can zoom in on the charts. If you want to get back to the state where you were, you just double click on the chart. Clicking one of these will remove it. Double clicking it will cause it to be the only one in view. And the reason you might want to do something like that is the average run here is an average of all the simulations. It's not a simulation itself. And so potentially you would want to look at that one just to see what the average would look like over time. Coming back up to the statistics that are provided from this, most of the statistics will be self-explanatory, but I just want to touch on the max drawdown and the min drawdown. Out of all the trials that occur, the simulations that occur, we take the simulation with the highest drawdown. That will be your max drawdown here. And then we also capture the min drawdown. The min drawdown is essentially going to be your best case scenario. So it is still the maximum drawdown, but it's the maximum drawdown from the run that had the lowest maximum drawdown. So this is essentially your best case scenario out of the Monte Carlo simulations. Moving on, the cumulative net profit is self-explanatory. The net profit is a little bit unique. This one's essentially going to be an individual a graph of your individual P&Ls. And so you can see here looking at this that you have a lot of wins that are essentially very close. I would assume this strategy, I haven't actually looked at this strategy recently. I just loaded it up from one of the example strategies we have. And it looks like it probably has a max take profit because you're hitting a lot at that particular value. And then you do get more higher drawdowns, but you're getting more wins closer to the that are ultimately resolving in to a higher profit, which makes this strategy a profitable strategy. Coming down to the profit distribution, this profit distribution provides a box graph and also a histogram. So from the histogram, you can see that you have mostly winning trades, and this looks really good. From the histogram, just on the left side, you can see you do have losers here, quite a few losers that actually lose fairly significantly. Here, there's one here that looks like it's close to $900, but you just have a lot fewer of those, and so you can also see that from the profit distribution graph here. So the Z-score is going to look very similar to the profit distribution. The difference is really the math behind it. So this is taking the standard deviation away from the mean of your profits. And so the layout's generally going to look the same, but the factor of the numbers are going to be a little bit different. So if this is your preferred metric, then you can look at this one. The next one is going to be your probability cones. The probability cones can help you manage a trade throughout its life cycle. So the idea of the probability cones is to project the first or second standard deviation, which in fact you can change if you want to do a higher standard deviation than 2 standard deviations, and then get an idea if your strategy starts to deviate, or your equity curve starts to deviate from the projected point too much, you might decide you want to turn it off. Obviously, it's projecting up to the top side. You might not be too concerned about it, but it might still be something to be aware of. If it's projecting down to the downside, then that could be indicative of the strategy starting to fail. So based on the number of points here, you might want to increase the cone size. The other point that's probably could be important is where you actually have the location of the cone size. So this is going to start at the 90% point within this equity curve and project out, because we're not getting new data coming in. You could re-download some data, add it back in here, and then start it at a point that makes sense for when you started actually when you turned on your strategy, for example. And so you can move this curve along the chart for what makes sense for your strategy. There's also 2 models for calculating the probability cones. We have an exponential model, which is likely what you'll use most of the time, but there are cases specifically with strategies, oftentimes in traditional finance, or with strategies that just have outlying winners or losers. You might want to switch over to the linear model, and I will do that shortly here on another example. So the equity curve, again, is something you basically are going to get out of TradingView, so I won't touch on that too much. Let's go back up here. I'm going to upload another data set, and so this data set is going to be a different strategy. And this strategy we'll be looking at this strategy here that we see in TradingView. And so we can see here, this is a lower percent profitable strategy, but it has higher winners than losers, right? And so we can see it's 35.97% profitable. If we scroll down to where the profit distribution is, you can see most of the winners, or most of the trades are actually losers, but you have a few outliers here that are causing the strategy to remain profitable. So you can also see that on the box plot here. So yeah, you had one strategy that was $422,000. That would be nice. But down to at the profitability cones, you can see using the exponential model in this case does not work. And so you can change over to the linear model to help you manage that trade in this context. Okay. I hope that explains everything. Let me know if you have any questions. Enjoy.